Welcome to Hotel Kolhapuri Swagat. Let us have a brief discussion over the models that we have made. Sir, do non-veg burgers. So, coming to the model that we have made, we'll start off directly with the assumption. So, let's start off with the revenue first, Kanishka.
Yeah. So, the Venky's is able to sell 20,680 units on a yearly basis, and we have kept the expected rate of growth at 10%. And the average price of the burger is 103 rupees. So, this average price has been come up from the three most selling burgers in the Venky's outlet. The discount that the Venky's outlet is providing is 10% flat because the main customer base are price tags.
Okay. Now coming down to the COGS or cost of goods sold, raw materials eat up most of the cost that is incurred by Hotel Kolhapuri. So raw materials we have assumed and as discussed with the owner, we have kept it as 35% yearly basis. There is no growth in the overall expense. We have kept it stagnant at 35 for the next 10 years as well. And coming to the wages, since there are very low employees here, so the wages are also very low. At 3%, the wages, employee wages are very low. And then lastly, coming to the transportation cost, that is bringing the raw materials from Pune till here on the car that we'll discuss later. In the car that is owned by the hotel, we have kept it as 7%. The expenses incurred by that car. That's all. Apart from all this, we have also incurred employee cost, marketing and SG&A, which come under operating expenses, which are very minimal at 4%, 5% and 6% each. And lastly, the tax rate will be explained by Kanishka.
So the tax rate is of the Venky's outlet is 12%, and also out of the total revenue that the Venky's is able to earn in a year, 40% is the profit of the outlet and the rest 60% goes into the cost.
Okay, that's it for the assumptions. Now that we're done with the basic assumptions, we are almost 90% done with our whole model, as Sir said. So coming down to the income statement, which is the base for our whole model. So we'll directly start off with the revenue that the outlet generates. So the gross revenue is starting with 21 lakhs, almost 21 lakhs plus, and the rest of the years are estimated for the further 10 years with the amount of growth as explained in the assumptions. So from these amounts, as stated in the assumptions, the percentages are calculated. For example, the 10% of 21 lakh 30,040 rupees is 2 lakh 13,004 rupees, which is the discount. So just like that, we have calculated each and everything till the total operating expenses and EBITDA. So that is it. We have already discussed. We wouldn't like to repeat the stuff that we have already spoken about. So continuing with the depreciation, Kanishka, would you like to share something?
Yeah. So the depreciation and amortization, as we know that this is incurred on the fixed assets of the company. So there is a different sheet called the fixed asset sheet. We'll talk about that later. So the depreciation amount is completely derived from that. And next comes after deducting the depreciation from the EBITDA, we come to EBIT. EBIT means earning before interest and tax. So deducting the interest expense is incurred on the car loan that the company has taken. That is for 5 years. So the interest expense are only there for 5 years, and after that there are no such loans. And after deducting the interest expense, we come to earning before tax. Earning before tax, to calculate the net profit of the outlet, we need to deduct tax amount. So the tax amount, as we know that it's 12%. So taking the 12% of the earning before tax, we come to the net profit of the company. And the gross revenue is calculated on the basis of the unit sold multiplied with the price, average price of the product. That's all for the income statement. So now let us talk about the fixed asset sheet. So Vanke's has a wide range of assets and it's an asset heavy outlet. From that we have two assets, the exhaust fan and the counter of the outlet that are that have a shelf life below 10 years. So the company needs to reinvest its capital on purchasing those after the end of the shelf life. Now Anish will tell how the depreciation has been calculated.
Now that we have calculated the capital expenditure, we know about the asset life, the capital expenditure that we have done, and the estimated scrap value. From these three values, we can easily calculate the depreciation, and that is exactly what we have done for all the assets that we have noted down, and including the two assets which are exhaust fan and the counter, which are to be reinvested. So for that, the depreciation will be increasing in the oncoming years when the asset is reinvested upon. So that is all for about the depreciation. Other depreciations are just the same and stable. That's all. Now that we come down to the balance sheet of the company, this is pretty basic and pretty small balance sheet that we have come across with. So coming down to the current assets, which boils down to just the cash, which is actually calculated from the cash flow that we'll see later on. And secondly, the non-current assets. So the non-current assets mainly include the fixed assets that we just discussed in the past segment, and as well as the accumulated depreciation, which we get the value as net fixed assets, and which make up the non-current assets. So there are basically two assets in the company: cash, which is coming from the cash flow, and fixed asset, which comes from the past discussion that we had. That is all for the assets.
So now I'll be talking about the liabilities and the equity of the company. So as we talked earlier that the company has only one car loan, so it is the long-term debt. So it is only the long-term debt of the Vanke's outlet, and so that only makes up the total liabilities of the company. Now coming to the equity part, the equity basically consists of the retained earnings that the company has on a yearly basis. The yearly basis is increasing on a year-to-year basis, and the retained earnings are kept to be reinvested in the future in case of any big capital expenditures. That's all for the balance sheet.
Now coming down to the cash flow statement, which is the base for the cash values that we have got for the balance sheet. So the net income generated by the company is the base for our cash flow, which is the surplus from the P&L statement. So coming down to the operating activities, there is just one non-cash expense, that is depreciation, and there is no amortization and nothing from the operating activities that we could have found or estimated. Apart from this, this actually is an asset-centric company, but even other than that, there is just I think there's all the depreciation accumulated from all the assets that we just spoke about. Apart from that, there's just the investing activities which we came across in the capital expenditure, and that is all for the from my side in the cash flow statement.
The financing activities include the debt repayment and the net borrowing. So the net borrowing will be incurred on only first year, that is 9 lakh rupees, and the debt repayment will be on a 5-year basis. So the company will gradually repay some part of the debt in that is on the basis of 5 years. So the net cash flow, so the final remarks on the cash flow statement are: it has a positive cash flow. The net cash flow is positive for almost all the years, rather than the heavy investment on the fixed assets. That is a very good sign for the company, and which have higher growth prospects in the future.
So even apart from that, just as a concluding remark, this company is heavily asset centric, as we said multiple times, which is a great sign for the potential growth that the company may foresee in the future. And apart from that, as you must have seen, there are no debtors and no creditors, which can be considered neutral But even apart from that, there is no negative effects on the business from this. And since the USP of this business is burgers and it is selling at a large scale in Lavasa, this has the potential to grow in Lavasa very well. So that is all from our side. Thank you so much for your time.
Thank you.
And have a good day. Thank you.